Hi, Ron LeGrand here. Before we get started with the podcast, I thought you might want to know that I recently recorded a 90-minute online training about how we make so much money today in the terms business. That's on pretty houses in pretty neighborhoods, not the junk houses that we have to go rehab or wholesale. I go through step by step on exactly what I and thousands of my students are doing right now to make the fastest and the easiest money in real estate without using your money or credit. If you're interested in doing just that, go to thementorpodcast.com/free training. See you there.
Welcome to the Mentor Podcast, where the most highly motivated entrepreneurs come to get their weekly dose of financial stability with host Ron LeGrand, as well as other nationally recognized thought leaders who will teach you how to get, grow, and protect your wealth.
Well, hello, everybody. This is Ron LeGrand with another episode of the Mentor Podcast. Glad to have you. Today's subject is why it may be a bad idea to sell. Now, look, I know from the beginning of your career, if you're in it, or your thought process, if you're just beginning, is to go get that check, get it as fast as you can, because that's all we can think about is getting our hands on that check. Well, got good news. We can get our hands on that check, but we can get a lot of more checks by not selling the property now. So I'm going to explain. A lot of people come into the business and they think it's all about wholesaling and rehabbing and retailing, which it is. That's exactly what most people are doing out there, and that's what the television shows are all about. There are disadvantages to doing that, and there are advantages to not getting that check in your hand as fast as you can. So I'm going to go over them for you, and I'll let you make a decision on what's best for you. And I'm guessing that if you're a real estate investor, you're going to be doing a little of both anyway. First of all, when you wholesale a house, what are you going to make? $10,000, $15,000? That's the average profit. And then what? And then you spend it, and then you pay maximum capital gains on it because you didn't hold a house for a year. And then you got to go do it again and again and again. So really it's just a job. And frankly, the same is with rehabbing houses, except it takes a lot longer. Okay, checks might be a little bigger, like maybe either the average is $25,000 to $40,000 net profit, but we're talking about months of raising capital and doing all of that work and taking all of that risk and hiring contractors and dealing with banks and picky buyers and all of that. There's nothing wrong with rehabbing. I've done over 1,000 of them, and I still do 1 or 2 a year. I'm certainly not going to make it my business. I used to, I'm not now. And there's nothing wrong with wholesaling, properly placed. But again, I don't see wholesaling as a business. Now, I know a lot of people that are wholesaling as a business, and they're making darn good money at it. But they've also got a systemization involved with a big crew, and they run it like a business. There's a difference between being in the business and running a business. And those that I know of that are doing over 100, 150 deals a year wholesaling, they have a very systemized, organized business. Of course, they didn't start that way. However, they still have the same problems as a person doing one wholesaler a month. And that is they don't have any residual income, no long-term growth, and none of that benefits I'm going to discuss here in just a second. So again, I'll be the first to tell you that if you need money like you need oxygen, you don't care about any of this stuff I'm about to say, you're going to go get that check and you want it as fast as you can get it. Hey, I'm with you, brother. I'm with you, because I'm telling you, there was a time for me to get my hands on a $10,000 check was, all I could think about day in and day out because I needed it so bad. However, the good news is if you combine what you're doing, if you're doing the wholesaling or rehabbing with the pretty house business, you get a lot of other advantages you don't get in wholesaling and rehabbing. For example, in my world, instead of selling the property, I fight real hard not to sell the property. Okay, I don't need the cash. So in my case, in rare cases will I sell. In most cases, I will not sell. If I needed the cash, like back in the old days, of course, I'd sell everything I can get my hands on as fast as I could go. But then you're just creating a bad habit. And in my opinion, it is a bad habit, okay? I hang around some very successful people. Some of them have been at this for over 20 years, and they still haven't come to the conclusion that flipping them as fast as you can get your hands on them is a bad habit. And if that happens to be you, just think about what would your life be like if you had held on to at least 50% of the properties you have flipped over the years. Most of them would be free and clear by now, I'm sure. Now, what kind of a financial position would that put you in? So just think about all the benefits you would have gained. First of all, look at all that depreciation you would have received over the years, knocking down your taxes. Depreciation is a gift from the IRS. Most people sell it short. When you have enough real estate out there, you literally can wipe out your income taxes just because you own the property. So get your head around depreciation. I did a podcast recently, and I went through the formula on it. It's really simple. Take your purchase price and subtract out what you think the land value is. I use 10%, and the rest of that is your basis. You divide that by 27 and a half years, and that's how much of a tax write-off you get that year. And I mean, just do the math on the properties that you have, and you'll find that that's a substantial tax reduction in itself. So honestly, I find myself buying properties. The main reason is depreciation, because I'm in a 37% tax bracket. And that's not going to change when you're wholesaling and rehabbing. All you're going to do is make your tax situation worse. Because if you sell that property within the first year, you're at maximum taxes, whichever bracket you're in. And if you're doing any business, you're in the 37% bracket. That means 37 cents out of every dollar you bring in after about $500,000 or $600,000 is taxed at 37%. So there, look at all that money you're giving to the government. Whereas if you just hold on to it for a year, it just takes a year, that drops down to 15%, 20% if you're a really high tax bracket. That's a big difference. I mean, that's probably half of the taxes that you save. Now, when you take time and learn how to do 1031 exchanges properly, well, and there's a lesson on my Gold Club, ronsgoldclub.com, where I show you how to take one house and exchange it into 3 houses and triple your assets, triple your income, triple your cash, and triple everything, and not pay taxes on it ever. And I'm going to have Brian and Lynette Wolff on here in just a few minutes to show you the benefit of keeping properties. And frankly, I got that idea from Brian Wolff. I understood exchanges, but I didn't see how we did it. Go to the Gold Club and see. There's a lesson on 1031 exchanges, and it'll blow you away. I promise you. You don't ever have to pay taxes on real estate, unless you're selling them in the first year, unless you're acting like a dealer, and unless you're acting like a real true flipper. In that case, you will pay taxes. Now, what I do is, instead of selling them, I put lease option tenant buyers in them. I lease them with an option to buy. And I can do this whether they're in excellent condition or whether they need work. If they're in excellent condition, I just lease them with an option to buy, get a big non-refundable deposit measured in the thousands, not the hundreds, the thousands. I'm not renting, I'm leasing with an option to buy. So I'm collecting a big option deposit, not security deposit. Those option deposits, I don't even want to do a deal with less than a $20,000 option deposit. And friends, that's only a $250,000 house, for crying out loud. So from there, we go way up. And the bigger the properties, the higher priced properties we buy, the bigger those deposits get. And I want you to compare that to your rehab profits that took you several months and all those costly entanglements to get. I mean, we get that money up front without having to touch the pretty houses in the pretty neighborhoods. And then we get all the other benefits I'm about to describe. What do you get when you rehab? You get a check. After you've spent a lot of money, now you hopefully get a bigger check back, and you give a bunch of it to the IRS in the following year. Not true if you put a lease option tenant buyer in the house. Now, if you're in Texas, of course, sorry, you can't do that. You have to buy it with owner financing and sell it with owner financing, or straight rent it. So you have to understand your Texas rules, or move, one of the two. So big deposits is the thing that most of the people are going after, because they will make you a lot of money if you don't even have the rest of the benefits. I mean, those deposits can really, really grow quickly. For example, let's say I'm doing $1 million house. I can do $1 million house without no more risk than I can do on a $200,000 house, but my deposit is going to be a minimum of $100,000 to hand somebody the keys. Take that same house. Friends, they'd have to have 20% down to go to the bank and get a loan on it if they were qualified. Well, that's $200,000. All right, I don't need $200,000, but nobody will get in that house without giving me at least $100,000. So if I can get into that house with little or nothing down, which we do quite frequently, and in that case, the definition of little could be, I don't know, $25,000 down. Okay, I'm still $75,000 to the good. Compare that to going out and rehabbing a house again. Okay, and next there's the cash flow. There's the amount of money you're collecting from the rent and the amount of money you're paying to the bank or to the seller. And there's always a spread. There's almost always a spread, okay? You get to keep that spread. You have no such spread with wholesaling and rehabbing. All you do is pay out. You don't get any money in. That money could go on for years. That's called residual income. That's what I want my students to focus on, because it's that monthly spread that'll make you feel like you're a millionaire, even if you're not. Soon you will be. It's about cash flow, ladies and gentlemen. Get the cash flow up. Get more money coming in than you need to live on, a lot more. And you can do that just with the spreads and call those big old non-refundable deposits bonuses. Of course, you're going to be glad you got them, trust me, but I'd like to see you get your spread 3 or 4 times what your current living needs are, and you'll feel real good about what you've accomplished, because now you can go away and take a month off. You can be sick, you can be gone, dead, and that money's going to keep on coming in to your heirs. So if I were you, I'd work strongly on getting that cash flow as high as you can. And honestly, it don't take but a handful of houses to circumvent what most people make in a whole year working on a job. And then, of course, some of those tenant buyers might cash you out. In my case, only about 10% of them do, because I don't do anything to make them cash me out. I don't force them. I don't chase them. I hope they don't cash me out, because I learned this a long time ago. The longer you own the house, the more money you make. No exceptions. So I don't want to sell it, see, because I don't have to have that almighty check at the back end, because I've reconditioned myself that I need to do more to hang on to it than I do to sell it. So once in a while you get a call, they're going to cash you out. All right, so you go another check on the back end, go buy another house and do it again. That golden goose has died, but there's plenty more out there. And you got paid very handsomely for putting that tenant buyer in there. And hey, when they buy, I'm happy for them. I really am. I'm happy for them. They earned it. They deserve it. And that's the whole game, is to lease option it to them and put them in the house and give them time to clean up whatever's broke, because about 70% of the people out there looking to buy a house right now can't qualify. So that's 70% I'm going to put in there, and I'm going to give them time to fix whatever's broke. I'm not fixing it. They're fixing it. But when they do, every once in a while, they'll go get a loan, especially in a hot market, especially when the interest rates are really low. All right. So you got that back end payday. You got that depreciation. You got the front end payday, and you got the monthly cash flow. Okay. Now you've also got appreciation. You see, when you own the house, hopefully the value keeps going up. Just take a look back the last few years and see what's happened to real estate where you live. The value just keeps going up and up and up and up and up. And that's free money for you. You don't do anything to earn that except buy that house. And by the way, you have to buy it. You can't get any of these benefits with leasing, where you get a couple, but you need to own the house to get depreciation and appreciation. All right. And then you get debt pay down. Now, this is big, and I'm going to have the Wolff come on here and give you an example of the property that they just sold of theirs recently and what that was worth to them. In fact, I'm going to ask them several questions, and you're going to see what one house produced for them, because they weren't in a big hurry to get it sold on the back end. That debt pay down is sometimes forgotten by investors, but they put people in these houses, and a few years goes by and they look at holy moly, that thing is paid way down. That's free money. That's free money. That's money your tenant gave you because they paid you a fixed rent, and your debt amount of your debt goes down every single month. Now, add to that the forfeited deposits. As I said, only about 10% of my tenant buyers buy. All right. That's not me. I mean, it's their decision. It's not my decision. But when they move, they forfeit that deposit. They know that when they went in. It's not a security deposit. It's a non-refundable option deposit. So when they forfeit that deposit, you get to go do it again, collect another big deposit, and keep all the money. Yes, you get to keep that money. You don't give that money back. It's clearly stated in the documents up front that it's non-refundable. I mean, it's signed with an attorney, non-refundable. It's applied toward their purchase price if they buy, lowering the purchase price, and applied toward their down payment. But if they don't buy, it's clear they will forfeit that down payment. So that's a huge revenue stream for you, because if I only about 10% of my folks buy, that means 90% of them move sooner or later, and I get to go out and do it again. I've had houses where I'm on my 5th and 6th tenant buyer in them, and that means a non-refundable deposit every single time I put someone in there. And incidentally, when I put somebody in the house, they're responsible for all the repairs. All the repairs. If the house is pretty when I put them in, I'll warrant the systems for 30 days. After that, it's all on them. It's a condition of their option. If the house needs work when I put them in, on what I call a work for equity program, They're responsible for all the repairs the day I hand them the keys. In exchange, I give them a little discount on the price. So I can lease option houses whether they need work or whether they don't need work. So I would prefer to lease option them if they don't need work in most cases. Some cases I decide to go ahead and do the work because it's minor and I can get maximum dollar for it. And we always raise the price above what we think it appraised for. And I can do that when the house is in really nice shape, and then I get more down payment. Because if I put them in the house when it needs work, they're probably going to want to take some of their money and apply it toward repairs on the house. All right. So think about all of these income streams compared to flips where you get one check and you have to pay maximum taxes on it. All right. I'm going to bring the Wolffs on here in just a minute, but let me make a case for flipping now, because I've done a lot of flipping. I've wholesaled at least 1,000 houses, friends. I guarantee you at least 1,000 houses. Okay. So here's my decision-making factor. If I get a house in a war zone, meaning a low-income, crime-ridden area, I don't want to keep it. I'm going to flip it. I'm going to flip it to a landlord or someone else who isn't smart enough to know that's not the place to rehab and retail yet. Because in those kind of areas, they'll be unrehabbed before you can get them rehabbed. And that's not where your qualified buyers want to live. Qualified buyers will move outside of that area where they can buy a house for the same price or not much higher and feel safe. But I can flip all of those I can get my hands on wholesale. And I have no problem doing that. Okay. It's the bottom end, but they're nice checks. If I can't make $10,000 on a wholesale deal, I don't want to touch it. And I'm usually make more than that. So what? It's a paper shuffle. And I got to confess, it is the easiest way to make money in real estate is just do the paper shuffle flip. But again, it's only to get a check now. It's not the property I want to hold for long term, because I've had a bunch of them. And trust me, I'd rather not hold war zone properties for long term. But I don't have, when I get that check, it does not say war zone on it. It says, cash me, please. Okay, so I got no problem with those. All right, not enough profit. Sometimes you run across properties that you can buy, especially those that you can take over to seller's debt or the seller will finance that need work, but there's not enough spread in it to make me want to repair it. Okay. Sometimes I just as soon flip it, wholesale it, and be done with it because the math just doesn't make sense on it. And if that's the case, no problem. Wholesale that thing and get it out of your life and get a check. Because investors today in this market will pay stupid prices for these houses that need rehab. I mean, I do not know where to get their training, but I'm telling you, I'm going to take advantage of it. And I'll sell houses today for a higher percentage of the after repair value than I ever could in the past. So it's a good time to sell them if you don't want to keep them and turn them into golden geese. Sometimes when you get really, really active, you just got too many houses on hand and you'd rather just blow some out, even though you could rehab them and retail them. You'd rather just choose to flip them. You might even be able to lease option to tenant buyers, but as is. But I've been in cases where I've just had too many on hand, and I'd just rather get rid of some of them, especially if they come with a payment that you're responsible for making, and blow them out. Okay, too much inventory is really a bad thing for any company, no matter what that inventory is. I doubt most of you are at that situation right now, but if you were, I don't mind you wholesaling. And then, of course, there's always, I got to have the money and I got to have it quick. All right, who cares? Just get rid of it, get a check, and be done with it. And as you grow and as you create cash flow, you'll get a better thinking process about not selling everything you get your hands on. Okay, if Brian and Lynette Wolff, would you happen to be on here right now? Because if you are, this would be a good time for you to jump in. And I'm going to use them because they're a very good example of what happens when you don't sell the house immediately. All right. So I hope I've made the case that your inclination is, and maybe even your training, and look, I'm guilty. I might be the one that trained you to go flip it and get your hands on it. But in time, you'll learn that there's tomorrow, and it is what happens after today. And you got to think ahead. Now, I'd be the first to tell you, you got to take care of your cash flow needs first. No question about it, whatever that's going to take. But then once you get those cash flow needs taken care of, stop selling everything you get your hands on. Now, that's why I like the pretty house business, to be honest with you. I can go buy nice houses in nice neighborhoods with terms And I don't have to worry about whether I'm going to wholesale it or not, because yes, I'm not paying anywhere near deeply discounted wholesale price, but I'm not paying for it in cash either. Okay. I'm either giving the seller financing or I'm taking over a debt that they have. There's no way I'm going to sell that house to some other investor. I'm going to get just as much money putting an owner occupant couple in there, or lease option couple in there, getting a big deposit from them than I'd ever get from an investor anyway. All right, I have with me today Mr. Brian and Miss Lynette Wolff, dressed in yellow. I like that yellow, guys. It looks nice. Makes you look sharp.
Thank you.
Thank you.
All right. Now, listen, this couple is in Phoenix, and they've been around for 17 years now, and they are avid practitioners of the terms business. And they are also mentors of ours, working with students one-on-one, and have been for a long time now. And Brian was telling me the story not too long ago about a house that they just now sold. How long have you owned that house, Brian? What did you tell me? 11?
We actually had that house for 17 years.
17 years. Wow.
Right.
Okay. And, and when you bought the house, what did you pay for it?
We actually bought it for $180,000.
And that was a subject too. You just took over the debt, right?
Actually, what it was we took over the debt was 162 at the time. So we actually took over that debt. Yeah. And obviously there was an $18,000 spread left over there. And we negotiated what we call super seller financing, no interest, no payment seller financing, where we're just going to pay that when we cash out.
Okay. So you just paid their payment and you owed them the rest when you cashed out.
Yes.
Okay. That's a long time to owe them. All right.
Well, what happened now, this is interesting because we went back. And this is an income stream that people don't always think of. We call it, what do you call it, honey?
The deal after the deal. I heard that from a very wise, good-looking man named Ron LeGrand.
Yeah. So we actually went back to them on this $15,000. There was $15,000 because they wanted $3,000 down. So we actually did give them $3,000 down. It wasn't a pure nothing down deal. And then the $15,000, we got a big non-refundable deposit from another buyer down the road. And so we called them and said, hey, would you be interested in just getting some cash now? A lot of times a bird in the hand's better than two birds in the bush.
Well, what'd they take?
We actually settled that 15 for 5,000.
Okay.
Yeah.
So you made another 10,000 for flapping your lips, and you made that a long time ago.
That's right. Yep.
All right. So you bought the house for 190.
180.
You got it for $3,000 down.
Yes.
You put a lease option tenant buyer in it. I want to know how many, you collected 15 on that one. How many times did you put lease option tenant buyers in this house over these years?
The fifth one bought. So we had four. Yeah. Four that had moved in and then moved out. And I always tell our students, make sure you say non-refundable option deposit several times when you're setting this deal up. They know they're not getting this money back.
So Brian, how much did you collect in non-refundable deposits?
$98,000 on that.
Jeez, okay. So you collected more than half what you paid for the house just in non-refundable deposits, huh?
Yes.
All right. Okay, now you got cash flow every single month over all those years. And I ask you to add up all that cash flow on that house.
That's right. Now, in the beginning, the payment was $1,275 and it was a fixed rate mortgage. It never changed over the 17 years. However, what we charged, we started at $1,495. We ended at $1,995 rent for this place. And so the best years we had was $8,600 profit that year. In the beginning, we were only getting about $2,600. So over all those years, it averaged to $83,000.
$83,000 in positive cash flow.
So another $83,000 in monthly cash flow.
That's right.
Now, you depreciated this house all that time too, didn't you?
Yes, we did, for sure.
Did you go back and figure up your depreciation like I asked you?
Yeah, we did. So obviously this house right now, I mean, when it was $300,000, you could almost deduct 25 for the land, and then you've got a perfect number of 275 because you divide it by 27.5 and you get exactly 10,000 per year.
That's not what you paid for. You paid 180.
Yes.
Yes, we paid 180.
But then the value went up over time as well. So you can depreciate more as the value goes up. So we ended up depreciating 54,000 over the 17 years.
All right. So that's money.
Tax benefit because we actually depreciate a lot more than that. That's just our 35% of.
So you mean You saved 58,000.
Yeah, 54,000. We saved
4,000 taxes. Okay, well, that's a big difference. All right.
Yes, we
Yes.
saved that much. Now we actually deducted a lot more than that, about 3 times that.
Okay. So when you sold this house, what was the size of the check you got?
That was our back end payday, and this was a big one. It was $278,000. Yeah.
So you got a check for $278,000
Yes.
after they paid off the remaining debt.
No, yes, that's right. So that reflects some appreciation, $115,000 in appreciation. So yes, if you had zero appreciation though, you still made a huge profit. You'll see when we tell you the bottom line here, but we made $115,000 on appreciation. And then on mortgage principal pay down, we made $111,000 because
So you got $111,000 in debt reduction.
Yeah.
Right.
Because you didn't flip the house. All right. Now, what's the big question here? What's the total net profit on this house you paid $180,000 for?
I tell them.
Yeah, you can tell them. Well, now listen, let me say this first. We would have, if it had sold in the first year, we calculated the number. If we would have sold it in 12 months within our first lease purchase time period, we would have made $37,500. Because we held on to the house for 17 years, honey, what did we make?
$493,300.
Holy, get out of here. And
almost $500,000 on one house.
And that's net profit.
Yes. That's our net profit.
Okay. Well, man, I can't think of a better example of why you shouldn't sell than that one, guys. I can tell you that right now.
That's right.
Well, I appreciate that. And I got to get off of this thing because we're out of time. But before I do, I want to give everybody a chance to go and learn what we know, because I did a 1 hour and 15-minute online training on this terms business that the Wolffs and I like so much and that we both teach. And you can get there by going to thementorpodcast.com/PC, thementorpodcast.com/PC. And you'll learn, I went through all the steps of the pretty house business, all the steps, the scripts, the whole works. So go there and check it out. And of course, there's no charge. And you'll see why the Wolffs and so many of our students are doing so well around the country. So thank you, guys.
You bet.
Listeners, and we'll see you on the next The Mentor
We
Podcast.
love you, Ron.
Yes, thank you, Ron.
You changed our life.
Bye-bye.
That's all for this edition of the Mentor Podcast. To connect with Ron and learn how you can attain financial freedom, as well as up-to-date strategies to grow and protect your wealth based on today's discussion, go to www.connectwiththementor.com.